Got caught moving the desk. How you doing, friends? Coach Ernie here, and this is the final hour show for 0DTE. And today we have a special show, only because it's, I would say, out of the ordinary or edge case. We're going to explore edge cases. You know, there are market days that laugh at your standard playbook. When volatility gets crushed, premium decays so fast there's barely any profit window, or when volatility spikes and price action becomes so chaotic you can't trust a directional bias for more than a few minutes. These are the extremes, and if you're not ready for them, they'll eat you alive. It's as simple as that. And you have to make sure that you put your phone on quiet so nobody calls. That's an extreme. There you go. On quiet now. So in these extremes, this is where two specialized structures come in. Now, as you know, we trade the classic out-of-the-money butterfly. So that's our mainstay. And we don't really deviate from that, but like I said, when there's super high volatility or very low volatility, we start losing some of our edge, and so we have to recapture that. And I'm going to describe exactly what happens and how we choose one over the other, and then how they actually come into play. But there are these two specialized structures that come into play are called the Batman and TimeWarp. Now, they are both out-of-the-money butterflies still, but it's the way we and when we use them. I mean, these weren't just theory trades or experiments. They were built in the middle of extreme conditions because nothing else was really working. TimeWarp was designed for really low VIX days, similar to what we have right now, although we're getting a little bit of volatility here in the end of today, where capturing compressed premium before it evaporates is really the game. And I'll explain exactly what that means, what happens in low volatility. If you're really wondering and you want to get a fine-grained idea of how volatility affects the rate of premium decay, then go back to, I think it's episode number 2, maybe episode number 3. So where we are at now, episode number 7 or 8? Yeah. But the Batman was engineered for the exact opposite when we have high volatility chaos, where you need two possible target zones because pinning the market to a single level is really just a fool's bet. So in this episode, we're going to break down the conditions that call for each one of these structures, how volatility shapes their design, and the specific management rules that make them work. You'll see how I decide which weapon to bring to market each morning and why having both in your 0DTE toolkit isn't optional. It's actually survival. So hopefully that sets it up for you. And we'll make sure that we have the comments section available. I do. Now the first thing I want to do is I want to show you our playbook. So every morning we go through a routine. And that routine is to analyze the market. We want to see where the volatility is, where market momentum is, determine a trend, and examine the structural elements of the market so we can see where support and resistance levels are. All of those are going to tell us what to trade, where to trade it, and when that event will happen. Now, volatility is our very first thing. And so virtually everything that we do is based on volatility, or volatility in time. So I'll say that most of the types of trades that I've been talking about over the past couple of weeks has been 0DTE, where we're doing this out-of-the-money butterfly for a single day. Now, as we go further and further into the final hour show, you'll see me talk more and more about multi-day DTE, going out to 3 to 5 days, 5 to 10 days, etc. And those are going to be fascinating, by the way. And then we'll bring it all together, how you trade all three at the same time. A day trade, and then these others that are akin to, I guess you could call them swing trades. So getting back to Batman and TimeWarp. So maybe we start with Batman, because that's the one that I know everyone asks me about. You know, they want to trade it all the time because they think that the reason why they're putting on a Batman is because they don't understand this directional trade stuff. They can't wrap their heads around allowing half the opportunities to go to waste. They think that if you have a trade on both sides, then you're going to make money all the time, but that's not true, because most of the time the market doesn't move hardly at all. All right, so the Batman really isn't for those really low volatility times, because you're essentially putting on two trades, doubling up the risk for a market that's unlikely to move very far. So that's why Batman is not really great for low volatility. However, when volatility is really elevated and you're getting all of those intraday swings and, you know, just chaos all over the place, you don't know if it's going up or down on any given day, then that's when the Batman sings. Does Batman sing? No. Okay, Batman doesn't sing. So let's take a look at the what I call the VIX playbook, and we'll see how we have determined when is the right time to trade these and when isn't. And what I would suggest is that you take a screenshot of this VIX playbook and start studying it, or adopt it as your own playbook. And oh, by the way, these trades have been developed over, and it's been at least 10 years. You know, coming in contact with all of these varying market conditions, super high volatility, super low volatility, and everything in between. And I've put on thousands and thousands of trades, and so these trades were built on top of empirical evidence, and they've been tested. They've been, I'm not going to say back tested, because all of the testing that I did was real life scenarios, so it's actual data. It's not hypothetical or made up. I've, you know, exhibited an incredible performance by trading these in the proper fashion. All right, but it really took a strong knowledge of how volatility affects the rate of premium decay, and what that really means in terms of market conditions, not only during the trading day, but also outside of trading hours. All right, so we're going to go to, no, not that. That is a trade that I was monitoring today. It was a gamma scalp, and we'll talk about those in some other future episode. But we're going to go to TradingView, where I have my playbook. This is our playbook. All right, and you can see I have all kinds of writing all over the place. We have the big ass fly, which is something that we'll talk about in the future. We have the classic out of the money with guide range, and then I have these other two guys here, Batman and TimeWarp. Now, we can trade the classic out of the money butterfly just about any time in just about any condition, except that when we start reaching the extremes, as we start going way up in volatility or way down in volatility, we start losing small edges, and so we want to recapture those edges with another strategy, similar strategy. I mean, we don't really want to change our overall way of approaching the market, because asymmetric positions, in our view, is really where it's at, and that's what we want to do. So what we do in super low volatility, well, let me explain what happens in really low volatility. I guess the best way to look at this is looking at a presentation that you've seen before, but not maybe this particular page. And what I'm going to show you is what happens in low volatility. All right, so we'll do that, and we'll go to Keynote. All right. So we saw this one yesterday, right? All right. So we're going to go back to this guy here. This is a life cycle of the extrinsic value and how it decays over the life cycle of an SPX option. Extrinsic value is time value, and the magenta line is showing how it decays over the 8 days of its life, each of these columns representing a day. So you can see that it slowly decays, then it speed up, until we get down to the last day where it just falls off of a cliff. Now that's why we trade 0DTE, because we have all of that premium time value there available to us. Now, when there's high volatility or low volatility, we're going to look at the next slide, how that premium decay curve changes. All right, so that's what the next curve is. All right, and this is kind of the basis behind the TimeWarp and the Batman trade. Now, in high volatility, the rate of decay, or what happens to options, is that they get inflated. And the reason why they get inflated is because there's a much greater range of movement. And that greater range of movement from a market's perspective means that there's greater opportunity to get into intrinsic value. So they inflate the price of options. And so what happens is that this curve, instead of this nice going straight down here, this average curve, it starts getting inflated, and it's way up here. In effect, it's being delayed. The premium decay is being delayed. So on the last day, you have way more premium available to you, way up here, right? So on those days, we have a lot more premium available. We can push our flies even further out, and we can make them much wider. Problem is, in that high volatility, because of the extreme movement back and forth, we don't know if a market's going to go up or down, and it might even go both ways in the same day. You know, where you get these huge intraday reversals. I'm sure you've been there. Now let's go to the other extreme. The other extreme is super low volatility, very similar to what we have right now. Now, in super low volatility, the exact opposite happens. The rate of premium decay increases dramatically, so that a lot of the decay happens on the days previous to the 0DTE day. So that by the time, so this rate of decay or decay line kind of looks like this, and all the premium is sucked out, right? So because of that, when you get to the last day, there's way less premium available to collect. It's way down here, as you can see over here. Available premium on the 0DTE. Very small amounts on low volatility, lots of it available in high volatility. So what's happening is that most of that premium is already gone on the day before or the day before that, right? You can see we can go all the way back to 2DTE, and we have about the same amount of premium left to collect as we did in high volatility on the last day. Right? That's the problem. That's it right there. So in the TimeWarp trade, what we do is, instead of going the 0DTE route, we extend it out to 1DTE. And so typically what we'll do is, at the end of the previous day, we'll put that trade on, and we'll set it up just like everything else. There is a difference, though. We're not putting it, trying to set it up based on a market event, although it would help if we could get it when price has hit a structural level, and we would then place the trade. We may or may not have that flexibility, but we do want to put it on near the end of the day, because that's going to give us our best advantage, or put it on the day before that. So 1 or 2 DTE. So how do we know when to do this? So first of all, we know when low volatility is a problem. There's also another problem with the TimeWarp trade besides the premium. You'll start getting, or what you'll probably notice, and I'm sure many of you have noticed this, is that in the morning hours, or the out of market hours time frame, either after the market's closed or before then, there seems to be a lot of movement that happens overnight. And then when we get to the trading day itself, there's not a lot of movement. Now, today was a little bit of an exception. There was a lot of movement, but there are some days where during the day, you get very, very small movement. So you get candles that are like little dojis, small little bodies and small little tails. But in between the days, you'll find that there is a great deal of movement. Like it moved overnight. And you have to consider that the market is only open for what, 6.5 hours? And there's still another 17.5 hours in the day. And so price tends to move a lot during that time, even though the market isn't open. The reality is that the S&P is open around the clock. Here, I'm going to go back and back here. The reality is that the S&P is open around the clock. It's just not everybody has a platform that allows them to trade it around the clock. So there are professionals out there trading it in off hours, and it's moving. And when there's low volatility and low liquidity, and they have some power, they have a lot more power in that kind of case, and so they're moving the market. That's why you get these gaps from one day to another in these low volatility times. And that sets up, two primary deterrents or detriments. Detriments is the right word. I guess it depends on where you put the emphasis, right? Detriments to the 0 DTE trade, because it is a directional trade. So we're looking for price to move into our fly. So we're looking for movement during the trading hours, and we're also looking to capture premium. But if there's not that much premium and the amount of movement isn't there, that kind of takes away a lot of our edge. So by going out a couple of days, a day or two, that restores some of that edge. We get to capture that increased premium decay by getting it before it decays 1 or 2 days out. And by giving us that time, we're also able to capture more of the market move. Now, we still trade with the trend. We try to place trades based on market structure. And we can also potentially go out a little wider because we've got time. So when I say a little wider, maybe an extra 10 points wider on your fly. All right, so let's go back to the trading view and look at the playbook. All right. So TimeWarp. You can see here the way this is set up. It's showing us when we're going to consider 0 DTE or 1 DTE. And when we're way up here in chaos or in the upper levels of Goldilocks, and for the most part, even the lower levels of Goldilocks, we're looking at 0 DTE. But if we start getting a condition where we're getting all these overnight gaps, we might want to go out another day. And then when we start getting even lower into the VIX levels, and now we're realizing that we're not getting enough premium to collect, we might more often go out 1 day or even 2 days or even 3 when you get really down there, right? So that's the playbook for TimeWarp. And what we're really looking for, what is really compelling us to move like this, is that when we start not only getting increased premium decay, in other words, much less premium to collect on that last day. And how do we know there's much less premium to collect on that last day? Because when we look at our options, trades, the wife's coming down with the dogs. She's having some trouble mobilizing them. Uh-oh. There they come. What, she kicked you out? Oh, here she comes. All right. So, where was I? I was talking about the premium decay, right? So let's take a look at a chart, and we're going to go back in time. We're going to go way back in time. We'll go we'll do a daily chart, and we're going to take a look at the SPX at the beginning of 2024. Oh, isn't that interesting? All right, so I have a lot of things marked up here that are looking for various type of things. But anyways, there was a lot of volatility during these times, and so we did a lot of introspection of price movement there. That's what all that is. But anyways, prior to that movement, let's turn some of that off. Prior to that, if we were to take a look at prices, let's see what the volatility was during that period of time. So we're talking about 2024. So for a long time, it was really in zombie land for a really long time and for very extended periods of time, as you can see right through here. All right, I'm going to just draw a box around it so you can see where I'm talking about all through here. Either in zombie land or just poking up into the Goldilocks zone and then coming right back down. And this is for months and months on end, just super low volatility. What do you do when you don't have a lot of premium to collect? Do you just keep on throwing on those butterflies, hoping that there's going to be enough premium for you to collect? Well, the answer is yes. But you have to adjust in order to take advantage of the opportunity. And there is opportunity here. But you have to understand that when there is low volatility like this, there's less premium. And so we're going to look something like this. This is the difference between high and low volatility. When there's high volatility and you're putting your butterfly on, let's say you're putting it on at the money and it's morning time, there's been very little premium decay. And so in high volatility, you have a lot of room. See it over here on the right? You have a lot of room to make profit because you have all of this, right? And that's because of the delayed decay of premium. You also have nice flat profit curves. So gamma is low. In low volatility, all that premium has already accelerated its decay. And so now you have very little room to profit. That's probably this is a great illustration for that. And you have very steep profit curves. That means you have high gamma or very high sensitivity to price. So you can see low volatility is a treacherous time. From an options trader's point of view, it is one of the most difficult times to trade, and it can be very frustrating. So in order to recapture all of that premium like you do on high volatility, we have to go multiple days out. All right? So that's the thing there. Let me go back to TradingView. All right, and so we can see that there was just low volatility throughout this whole time. And now we'll go to the SPX. We'll see what happened during that time. In 2024, what was happening? Well, in the beginning here, we were just on a long reach, and volatility really went down as we were on this bullish trend. Now, as we get up into that bullish trend, you'll start noticing things that happen with price and the daily bars. You'll see that the size of the bars, they start out pretty big down here, and then as you're going up, they start getting smaller and smaller. Now, not so much here because we were still in the aftermath of a lot of other things, but it really started to change in December and January, December of 2023 and January of 2024. We started to move up here, and you see all these tiny little days. Let's take a look at some of these days. Now, if you look at right here from November 14th right through, all the way up maybe to here in February of 2024, actually here, right in the beginning of January, you'll see that really tight days, we open at a price, and then the next day we close at a price, and the next day we open at that price. Same thing over and over. So there's really no overnight gaps. But watch what happens as we're going deeper and deeper into that bullish trend. See what's happening here? See all the gaps? Look at all those gaps. They're everywhere. And what those are overnight moves. The market is still moving and being traded, just not while you're trading it. But it is moving, and you're missing out on those. And in its place, you're getting all these tiny little dojis, these tiny little days with small bodies on the candles. Now, when we get a little bit of a reprieve when we pull back, but then it starts all over again. We move up again, and again, we get these big gaps everywhere, and then small days. You might get a couple of days where you get a little bit of a momentum push, and then, of course, when you have moves down, you get expanded range of prices because there's higher volatility, and then it all starts all over again. Now, if we bring it all the way to where we are now, we started exhibiting that gaps in between days through most of June. Here, you can see small movement during the day, small dojis, and then these big gaps in between days. Right? So we have to start looking at multi-day DTEs. Now that could either be a simple time warp, or we can start looking at what's called the convex stack. The convex stack is almost like a combination of a time warp and a Batman. And I'll explain that in a bit. So we're going up, 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 and really getting compressed. Here it's we have a lot of gaps here too, because if you really look closely, you'll see that we're moving up here, and then we gap down, and then up. There's some gaps in here, but this is pretty tight stuff here. It's not too bad, but here, and here, and here, really bad, and particularly over here at the beginning of 2024, it was just horrendous. Anyways, the beginning of 2024, because of these overnight moves, this is what really caused us to migrate and develop the Batman. I'm sorry, the time warp. I want to talk about Batman too, about the time warp. And so that was a trade that was really meant for extreme conditions. So as I said, the way we put that on is we simply put it on a day ahead, maybe 2 days ahead. Now since then, yeah, let me see if there are any questions. Well, thank you, Diego. Diego says, give likes to Coach Ernie. These episodes are very instructive. I hope they are. And yeah, let me just say that. If you're getting something out of these and you think that they're valuable, and you go back and you look at the series, and you'll see that what you're getting is a master course on options and zero DTE and multi-DTE trading. All right. Fantastic. So thumbs up. Also, make sure you share these videos. That helps tremendously. So thank you for the kind words. All right. So low volatility, we want to consider trying to recapture that premium by going out 1 day, maybe 2 days. Now, we have other trades that also do things like that, but it's a break from the zero DTE trades. We call these the multi-day trades or the tail risk trades. And they are also out of the money butterflies, but they're way more extreme, and they're looking for convexity. What is convexity? That's extreme asymmetry in risk to reward. We're looking for those trades that are just outside of the expected move. And I talked about this a little bit in previous episodes, that there's about 22% of the time that the market underprices or underestimates where the market can go. And it underestimates it by a lot. And so we like to play out there because those trades have explosive and huge returns for very, very little risk. Now, it's true that most of the trades that we trade are really, really tiny, or they don't work out, so we have a lower win rate. But the risk that we take is so small. I'm getting off on this subject a little bit, but the risk that we take, it's important that you know, because we are going to talk about Batmans in the context of convex trades. The risk is so small that we never draw down. We just basically go sideways until we get the next big hit. Sideways, big hit, sideways. So you are always going up. You're not doing these big loop-de-loops. So what we found was that these trades can essentially replace the traditional TimeWarp. When we first started to examine the TimeWarp, we actually placed it like a Batman. You would put it one day out, put it on both sides of the market. But instead of operating like we do with the Batman, where we had this rule, a 10% debit rule, where we never allow the debit to get over 10%, on a Batman, we made sure that if you did that with a 10% debit rule and both were at 10%, well, then you would have essentially 20% of the width, because the two debits, if your thumb was the debit on the fly, you're doubling it up. So now you're changing the risk to reward parameters dramatically. Now, a lot of people thought, well, that's okay. Maybe I just put a stop in or something, and and then it gives me a better chance to get here and there. But that's not the case. When you have low volatility, price isn't moving that much, so it likes to stay in between the two trades. And so now you're forced to put stops on, and we're forced to manage that risk. Now, if you've been watching me long enough, you know that I don't like managing the negative trades. I just don't. I want to have defined risk and then just focus on profit management. So what we did is we said, okay, just make sure that you push the trades out far enough like this so that the combined total of those two would equal no more than 10%. That way you weren't compelled to manage that risk. So that was our update to that. And then as we started to do that, we realized, man, if we go even further out, and instead of, say, 5% for each, if we go out to 2%, we're getting a much better performing strategy. And tactically, it made way more sense. Now, it doesn't seem that way. When you first look at it, you're thinking, man, if you go way out here, you're never going to profit at all. But the optionality of these trades, if you go out wide enough, as you go wider trades and push them further out, they start exhibiting incredible optionality. In other words, the profit curve from here all the way to the strategy itself is extremely lucrative. And if you just make small moves along that profit curve, given a very small risk, you still have the opportunity to take very early trades in the day with as much as 150, 250, 300% return on your money. So think about that. I know it looks like everyone thinks, oh, I have to get into the profit tent to make profit. No, you do not. You do not have to make it inside the profit tent to make money. In fact, the vast majority of our profits are made outside the profit tent. The vast majority. Well, I mean, we want to get into the profit tent, but quite frankly, in low volatility, the market doesn't move as much as we'd like it to. So we have to compensate for that. So going wider, further out of the money, and multi-day led to a different type of trading, well, plus some other things that we call convex stack. But it is a form of the Batman. We put them way out there on either side of the market, because over a number of days, we don't really have any idea where the market's going to go. It could go anywhere. We could turn around. We could go up one day, down the next. We could go up and down in the same day, like today. So because of that not knowing, that's really what led to that's one of the things that led to the Batman, plus these overnight swings, which sometimes can be, or overnight movement or gaps, sometimes led to really drastic moves and pretty big gaps. And of course, everyone's thinking, oh, well, the gap will fill. You know what the odds are that it's going to fill that day or the next day? They're pretty low. Yeah, it'll fill probably eventually because markets tend to retrace. But it may not fill that day, so I don't know what good that does you thinking the gap's going to fill. You can't play a fade the gap all the time, although that is a strategy. All right. So let's see. We have a question. Low volatility is, most of the time, related to markets going up. Therefore, should we use call fly only with TimeWarp, playing the market going up? It's a very good question. I would say no, only because when we start going out 1 or 2 days, you really don't know what's going to happen in those 2 days. There's, from an odds point of view, over 2 days, one of those days is probably going to go down, right? And you could be getting gaps overnight, and so that down move or up move could be very big. So no, we choose to go on both sides of the market as we push them further out. In low volatility, though, I see it, right? If we're trying to play really close to the vest and we're really doing, in low volatility, it's, those are the problems. Don't get confused. Batman in general is meant for higher volatility times. In the time warp, when we start going out even further days, that's where the convex stack comes in. We're taking much less risk and we put it on either side of the market. But on a 1 or 2 DTE, we're probably going to be playing just one side and going with the trend. Yeah, that's a murky area, when you start getting to 0, 1, 2, or 3 DTE. Because the plain fact is that the market's going to move, and it's going to move in unpredictable ways. There's nothing saying that it's going to keep on going on that trend. It can turn around at any time. And in the low volatility, we have those big overnight gaps. Well, let me just go back to the chart, and you tell me where you would decide after 1 or 2 days that you're going to choose a direction. All right. So we'll look at the SPX in 2024 from the beginning all the way through, actually. So yes, you have some stretching days, but then you have these type of days. So let's say you're super low in the volatility and you're wondering, okay, should I trade one side or the other? Well, I don't know. I mean, if you were here and you said that you want to put on a 2 DTE and you're going to go up, well, it ends up that it went down or stayed right where it was. Or if you were here taking that trade, look at this red candle. It's disruptive, right? You don't know where the market's going to go. It'd be wonderful if we could have certainty that over any 1, 2, 3, or 4 day period that the market is going to go in one direction. And it does every once in a while. But if you put on trades that have a low enough risk, you can afford to put them on both sides, right? That's the key. All right, let's see if we got any more questions. Okay, Diego's got it. Excellent. All right, I think we can kind of wrap it up here, and we'll go over these concepts again. Again, I would like you to copy this and see how we decide when to go time warp or Batman and why we would do those. And in coming episodes, we're going to start delving into some of the longer dated zero DTE and start to see the real power of the Batman trading and putting things way out of the money, much further than you ever thought possible or reasonable. And then over time, you're going to come to realize that not only are these reasonable ways to trade, but they're extremely powerful ways to trade. You're going to make lower drawdowns, much tighter control over your volatility of your returns, and more consistent profits by putting things way the hell out of the money, places where they're crazy. Let me just say that most traders, most professional traders that I know, they trade this way. They trade extremes. They're trading extreme risk to reward. Very few retail traders do it. They go the opposite way. They trade high risk to small reward so that they can get that high win rate, because they believe that that is their car to nirvana, their trip to nirvana. It's not. It's really a trip to despair. That's what it comes down to. All right. Wish we had more comments today, but we don't. So, not much to say there. Again, if you like this episode, give it a thumbs up and make sure you share it. And we will be, let's see. I never can tell which one of these buttons that I should push. I have to get... All right. Thank you very much. Coach Ernie here. We'll be back tomorrow with another great episode. And if you're interested in learning how to trade zero DTE in any market condition and achieve consistent profits, really great profits, very little risk, very little drawdown, and go down below and join our Fat Tail School community. It'll be the best move you've ever done in your trading life. I guarantee that. I really do. All right, Coach Ernie is out.